Is it
We
visible?
can, yeah, we can see your screen. Let's start.
Okay. Hi, my name is Siddharth Das. I'm here to present the company called Vivid Electromech Limited. So basically, this company is integrated mid-tier player basically into the industrial electrical equipments and the automotive value chain. Basically, this company manufactured these low voltage and medium voltage panels and currently aggressively getting into this data center where it's getting a good order book and trying to execute those orders and deliver those things. It's not a new player basically into the market. It's a old one. If I go into the next slide, if you see they have 30 years of experience into the engineering platform, and they have very good OEM partnership basically, which I will show you who are the top notch players where it is currently having partnership and they're working with, and they are having very good operational efficiency right now in terms of delivering and the margin that they are commanding right now. So the foundation, if you see, they started with 1990, and right now in 2026, gradually they has increased the facility, in-house manufacturing facility for low voltage panel productions right now. If you see in 2016, the capacity was 34,000 square feet in Navi Mumbai, and in 2023, they have opened a 12,000 square feet Pune facility, and right now the one which is currently in progress is the Ambernath automated mega facility, which is currently having the capacity of 1,20,000 square feet, which will give huge margin contribution to the revenue. So they have different verticals. If you see industrial, renewable energy, metro rail, infrastructure, utilities. But currently, the major revenue that is currently contributing for this electrical panels, that is coming from the data center that they are delivering and they're having the partnership with. And the other area also they are having revenue gradually, like renewable energy, metro rail. These all required, for the mail and metro and rail also that is required be qualified engineering, testing and quality that has to be approved. Otherwise, it will not survive. So they are into top notch on that category to deliver those things. And talking about the main part about the electrical panels, it has very good certificate certified by the partners like ABB, Siemens, L&T, and there are many other six clients they have because they have approved. So the high barrier that is coming into the picture, so low category panels which is being manufactured unauthorized by this player are not coming into the picture as part of this peer category. Also, if you see for this Vivid, the electromech company, they have peers like Sivalik Power and as well as Marine Electricals as well. But seems like how Vivid is currently progressing with their orders and the OEM partnership they have, that's how it is segregating from their competitors like Sivalik and Marines. Recently, they have own an order book of 30 crores, 31 crores, which they will going to be delivered by this end of year. And if you consider the facility they have, that will going to contribute by FY27. So talking about the management here, uh, Samir is one of the management person who is basically leading. He is a second gen entrepreneur. Basically, he is taking his father trading legacy and it is currently transforming into EPC, from the EPC contractor to the precision panel manufacturing. That's how it is basically moving towards, and they are representing themselves and using their responsibility like taking the strategic calls, customer relationship, how they have and how they are maintaining, and their R&D futures, uh, they are utilizing for the product development and all. Currently, promoters holdings they have around 73%, And with this institutional holding, so they have around 15%, and I think Motilal Oswal is having around 6% of their investment into it. Coming to the next slide, if you see the product portfolio, they have low voltage. Currently, it is up to 1000 volts they are basically delivering. And if you see the future tech upgrade, right, it is currently having fully type tested IEC 61439 panels, that is 800 volts, and the data center ASTA certified PDU and RPP will going to scaling from 500 kW to 1000 kilowatt. And they are moving from low voltage to the medium voltage right now. They want to cater the 3.3 kV to 33 kV specification infrastructure to cater to the clients. So current portfolio it's going to be like 11 kV to 33 kV VCP, and the other one if you see which is currently here, right, vacuum contractor panels and all. Now the expansion into this HT-APFC will going to give that boost, will going to in the near future, and yeah, that will take some time to get into that phase, which is currently in progress. And the Ambernath facility, which is currently planned officially, the construction plan to be completed by the August end, and the revenue start contributing by FY27 Q2 or Q3. So they have a order book backlog around 200 crores around. Uh, in that, 30 crores will be delivered by this year end, and the rest of around 150 around that will be going to be delivered by FI 27. So looking at that, if you see, they have a good healthy order book right now and in pipeline, and that is going to be or already in place. So with that, it will going to grow. And if you see the OEM mode, right, what I was currently I was talking about, they have the ABB licensed R-Turkey low voltage switchboards, and that is the primary OEM mode, and around 60% revenue is coming from this particular client itself. And they have other like L&T, Hitachi, and Siemens also. And all these are like certified, authorized OEM partnership, where they are having placed very separately from the other peers currently. Yeah, to the previous slide which I was talking about, right? So they are having their production, right? All things are like in-house. So starting from raw material inspections and fabrications for powder coating, then assembling, testing and validations, packaging to dispatch. So everything they are part of that, and currently without any right defect or bug, the high quality testing has to be done to deliver all the things. So that only can be approved by this client. They don't want any local peers to come in and right deliver those things. So they will have a certain order book category which has to be delivered by the authorized certified people. So right now VVD is placed in that category. As I mentioned, the Ambernath facility, which will going to commence by this August end, and once it contribute the margin right to the revenue and all, so you will see a huge margin expansions to that. Uh, but provided that if you see the history of the company, uh, it was around 32 crores around like 2021 and all the sales. Currently, it is in 200 crores. So with that, because all these are recurring revenue coming from these clients and the order book, so how they have progressed till now with that 30, 35% CAGR. It will continue to do that, and in next 3 5 years I can see. And evaluating that, the current market cap is currently 1000 crores around. So which is going to be right, if we calculate the projections wise as per their management guidance, it can easily reach to right 5000 to 6000 crores, 5000 to 6000 crores the market cap, and the sales can go up to right 900 crores, 2000 crores it can reach. The net profit also, how it is increasing right now, is going to maintain in the same similar fashion. I don't see any interference between their client management side. Like other player can come and take those things in next 3 5 years. It's not quite possible. Yes, Sivalik is already doing the expansion into the uh, facility wise as well, but the margin that Vivid is commanding right now is not currently achieved by Sivalik. That's why the PE right now, Vivid is having like around 35, 34, 35, right? Compared to Sivalik is having like 14, 15 PE. So it is stating clearly that they are having some uh, good margin and operational efficiency, and which is giving that premium to Vivid. Yeah, this I just talk about these things. So that's how it is going to increase. This is about the Ambernath facility. All the details which I talk about is in detail right now. And they have these facilities currently developed in Maharashtra. Uh, their product right now, business is into 15 states in India, and outside country also they are having business, but that is very less percentage wise. Mostly 95 to 96% business is in India right now in domestic, and the raw material also are dependent in domestic supply. They are not depending on the outside of India. So that's why they are taking that leverage. So if you see the how the growth is currently scaling and the margin is coming, right? The first is like the capacity that they are currently having in the Ambernath facility. Second is the intellectual property, right? Siemens CPAN 8PU and advanced data center PDUs, that's going to be a high margin tech. And the ecosystem that having, they have like the high moat OEM partnership, ABB, Hitachi, L&T, and few more, right? Top six clients they have. So this will give high exponential profit and volume that they are taking right now using Ambernath. So this is the vertical wise revenue that is coming in, but this may change, right, gradually over the quarters as they get more right order book from data center side from the other clients. So that will going to change. But yeah, stating that from the metro rail, they have a good amount of portion that is also coming. If that get increased gradually by next fiscal year, then yeah, it will contribute more on that. But as of now, the current focus, they are aggressively going into the data center. So having a like customer side, like why I will choose Vivid over others, right? One is like the application specific engineering they have, the way they are currently designing their product from end to end, right? Designing fabrications, then developing each of the product category and qualified by the testing and the authorizations that have from the clients. Combining these things and the speed that they have without compromising the quality, given state that they have like 2 months to 9 months of cycle of delivering the products, and some of the delivery they take based on the specific time period. Like they have certainly they have one of the client STT Global, they have provided the order book, but that currently they are expecting to be delivered by next 2 months. So yes, certainly they have the 2 months to 9 months category of cycle to deliver the end to end of the completion of the product. And few are like short period time, which they deliver fastly. So comparatively that among the peers, they're having a good advantage on that. And coming to right, some of the government projects where they are bidding it, like even there in that case also, in the rail and metro projects also, If you don't have the certain qualifications of the right certifications, they will not allow the others to come into that bidding process itself. So here also BVD is taking the advantage. Of course, the raw materials which is currently used like copper and steels is the major part that can impact the manufacturing and delivering the cost side. As so we cannot assume like always it can maintain the stock in the backyard and it can deliver those things. But yeah, sometimes it can get impacted also with that. If it can able to manage the volatility by having the projections near future on the stock side of copper and steels, then it can mitigate that issue. But stating that that can impact the margin in near future if that is going to go out of control of Vivid side. And coming to the competitive edge, this already we have discussed. They are doing. They are having authorized license guardrail and they're fully integrated in-house fabrications they are doing, which I talk about like 2 to 9 months of delivery times they take it to deliver. And they have a strict 2 hour SLA focus because their facility is currently situated in Maharashtra and Mumbai in Pune facility, which basically near the data center which they have uh, of Microsoft and the other as well. And this is the profit and loss statement of Vivid. If you see the sales from 2021 to 2026, it is currently growing at the rate of like 35 to 35 around percent is currently growing, and they have a high ROE compared to the other peers. And the net profit, if you see, till 2023, they was not having much, almost zero. But from 2024, it is currently exponentially growing it. And as per the current statement, right, the Ambernath facility, if currently if come into picture and start contributing, this net profit will going to increase based on 35% CAGR. And currently, if you see the chart, the technical chart side, it's currently trading around to 1233 rupees. So, having said that, if you follow some 50 DMA, then if it is coming nearby and the support level, if you see around 1000 or 1000 to 1050 level, then it will be a good place to right accumulate this stock. Of course, this is in the SME segment, so we have to keep in mind the risk side. And I can see, right, easily it can grow to the extent which I'm currently calculating about the sales side. It can reach around 900 to 1000 crores on the upside of the sales in next 4 to 5 years. The This is the top line side I'm saying. If bear case, if I'm talking, then it can grow till if the margin going to impact, then it will go till 2000 to 2500 crores. I mean, basically the market cap it will go, and the sales side can go around like 500 to 600 crores. Yeah, any questions?
Yeah,
Yeah,
great. Go ahead.
hello.
Yeah, go ahead.
Yeah. So I was looking at the cash flow from operations. So they are hardly collecting, realizing cash from the sales against profits of 20 and 32 crores for last 2 years. Cash flow from operations is just 3 and 7 crores. So can you throw some light on this?
Yeah, cash flow side, it is currently, I mean, as you said, right, it is having an impact. But gradually, I think that once the repetitive order comes and the Ambernath facilities come into picture, right? So the one which currently they are lagging, that will going to increase. I think they can maintain that in the coming quarters. So we have to closely watch how they are going to maintain the cash flow side. I don't think it will going to create a problem as such, but because they have good OEM clients, so that within right with that said, this the one which they are unable to have the cash flow right prior to that. Currently, because of the IPO came in April, I think going forward they will going to maintain, I think, that side. So we will see like how it is going to maintain.
Okay. Thank you.
Yeah, I said that. This marine electricals and these players are also peers to them for this LVMV panels. Like STT Global Data Centers also putting a lot of orders to marine electricals. Is it in the same space? That's what I wanted to understand.
Yeah, so Shivalik and Shivalik Power and Marine also into same place, but they don't have this ABB client actually. Siemens is also there for client for Shivalik, but the how Vivid is currently commanding the margin, Shivalik and Marine is not able to generate that much.
Okay, and the reason for that is, as per you, margin reason?
Main margin reason is like currently the factories, the outlet capacity that they currently having, right,
Okay.
that is currently giving such volume to them with these clients. So if you see, the major revenue is coming from ABB up to
Hmm.
TK, so
Yeah.
that having good margin which currently giving. The other ones are not having that much margin coming from these clients, even though they have, but due to some other like debt and other things, also they are lagging behind.
Okay. Yeah, recently also when I discussed with someone, their certifications playing a major role in getting the new orders, and the kind of time they're taking for testing the setups and other things for failure is also leading them to more orders faster actually. So that is also we need to keep track somewhere on this company.
Yes, yes.
Yeah. Okay, any sectoral tailwind panel industries could, yeah. So sectoral tailwind is there, Aman, in terms of data centers. A lot of these panels are going into that. So definitely there is a sector tailwind.
Yes, the main sector element is data center right now, and they are currently moving from, they are planning to move from the low voltage to medium voltage, but that is the future vision that they have, the management, to place themselves the engineering leader in that category.
Yeah. Okay. Thank you, Siddharth. Just keep a track on the chat for any more questions that comes. Then we can take up from there.
Sure, sure, thank you.
Yeah. Okay. So we'll move to our next presenter. Just
Yeah, I'll present.
yeah, Yogesh.
Yeah.
Go ahead.
Let me hide my personal things.
Yeah.
Okay, great. I hope you can see.
Yes, we can see that.
Are you seeing the presentation?
Yeah, presentation. You can do that.
Okay.
No, yes, we are able to see the presentation. You can go to the. Yeah, now it's good. Good to go.
Okay. Great. So certain disclaimers. I'm not a SEBI registered research analyst, so anything which I present here is not a recommendation, but it's just a personal opinion. And please do analyze. If you have any queries, we can collaborate and then answer. So what is that we are looking today is at a company in the IBD industry. The IBD industry is something which is going from say 1600 million to say 30 100 million, which is a CAGR of 12.2 percentage, right? That's what the RSP of the company, which you already see on the top right corner, that says. What is the in vitro diagnostics? So today, if you go for any kind of blood report testing or any kind of testing, for example, right, and you're just visiting any diagnostic center, so there what you're doing is you're wanting to test your immune system, you're wanting to test your bodily fluids, you're wanting to test your organs, right? So everything comes into the in vitro diagnostics. So, and that's what this industry presents, right? So one is where you go for immuno, how do I minimize this? When you go for just a second. Yeah, when you go for immunodiagnostics, that's what your blood thing says. So what you do is you give your blood sample. If you want to calculate your, say, anything in the blood, say, Just take any example. So what you do is you top it up with a reagent, and then it gives you any of the result, that what's your blood count or what's your sugar in this, right? And then there is clinical chemistry, then there is hematology. So if you want to go deeper into the blood samples, then there's a hematology. Hematology means that any kind of a reagent which will be helping you find what is there inside the blood. And then there are molecular ones which deal with the higher molecules, which are RNA, DNA based, right? And that's what this entire industry plays. So in all totality, it's the industry which is catching up, which is also growing. The parallel industry, the adjacent one to this, is the one which you have been seeing a lot of IPOs have been coming in there, which are the diagnostic ones, right? The ones which is flooded with the IPOs. But this is the one which provides a sampling to it, or the raw data or raw material to it, right? So what are the players in this? The top ones are Transasia, Molbio, Agape, and J Mitra. But then the company that we today are looking at is Qline Biotech, right? So in the size, it would be the fourth in the company. But why we are discussing this company is because it has come just for the IPO, and then the bet is totally on the promoter, also on the capacity that they are growing. The promoter here has been in the industry for since the industry has started. So he was one of the first sales engineers in the one of the very first diagnostic center, and then he has seen this industry go from very scratch to where it is today. And that's why the entire bet is the promoter understands the dynamics of this entire industry. So yeah, we'll go ahead and then see how does Q Line makes its business from. Yeah, what's the business model? So the business model for this company is it provides the different product lines. What are the product lines? It provides the regions, right? What are the regions? It again a simple strip or something that you will add and then onto a machine, and then you will get to know what your blood sample has, right? Then rapid cards, the same card that you are wanting to add. These are again the consumptions based, right? And then POC strips. So, then there are diagnostic instruments. What are these instruments? These are the analyzers. Now, what are these analyzers? These analyze if your fluid or bodily fluid needs to go through multiple processes, then these are the instruments that they need to go through. And then there are consumables which are again ancillary to these instruments that you need to, the pipette, and then all the things that you require to keep that machine operative. So those consumables. And then there is an annual maintenance services. So that's what this current share looks like, that they have taken their entire revenue 70% from the regions, rapid cards, and POC strips. The instruments, they have made to 25% of it, and that's what currently looks at. But then what is the game? The game is totally based on the razor and blade model. That's what they call it. What is the razor blade model that you use in the shaving, right? You buy the razor ones and then you keep changing the blade. Same goes for the analyzers. So what are the analyzers? They place these analyzers. These are the instrument machines that you would see in any of the diagnostic centers. You place these machines for the free of cost or very minimal cost, because generally that's the norm in the industry. It's like very similar to you go into any kirana shop and then you see a Pepsi fridge or a Coca-Cola fridge given by the distributor himself, right, or by the company, so that you can keep their products in there. And then the very same model here also applies, that you can put in any of the analyzer, and on top of that, anywhere when you will try to buy a reagent for that, that's a recurring revenue for them. So what's the recurring revenue look like? That's a pull. That's the 25 to 30,000 per machine revenue that you're looking at, right? And then there's a hematology department also, which is somewhere in the lower side, where the regions for those cost around 4,000 a month. And that is why the product composition matters in this company. That's what we have to look at, that what kind of region is it building, right? Is it clinical, is it hematologist, or is it even in future molecular? So let's see. And then you have the entire lifespan of this entire instrument is 8 to 10 years, where we are saying that Qline's entire 75 to 80% of this is into the closed system. What is the closed system? You buy the machine from me, you buy the reagent also from me. Why are there any stringent things that you cannot switch? There are certain guidelines from the government that you need to go through an entire admission process of the instrument. You have to go through the process of first vetting the full-on processes, the SOPs, the audits that you have to go through, and then the reagent is also approved, and then you activate that machine, that okay, then this reagent works with this, and then I can go ahead and then use this in my diagnostic center. And that is what the entire model places like. Why are we showing the manufactured versus traded here? Because this company, what it does is it manufactures some of the instruments, and it also trades some of the instrument. What does it manufacture? It manufactures the current diagnostic instruments, which it buys it on which it has actually gotten the technology transfer from the few of the companies, right, from the Europe. Now, why is that done so? Because in the technology transfer, Europe, there are a lot of problems in the semiconductor and then labor side. So what they have thought is, we will buy this technology transfer, we'll build it here, we'll pay some royalty to them, and then that's how the traded segment works. So if you see 50% of their revenue comes from in the instrument space, comes from the manufactured part, and 39.6 comes from the traded ones. Let's go to the next one. So why are we looking at it, right? Is that the only thing? Is that the only recurring revenue that we are going to go, and then is it going to give us that? So no, we will look at multiple parts and multiple instruments, multiple product segments. So let's see, how did the region grow here, and then how did the instrument grow here, right? Regions grew, instruments grew, consumable declined. We'll see why, right? And here the majority of the part here you can see here is in the manufactured versus traded in FY25, 169 crores came from the 169 crores came from the manufactured instruments, and traded were 144 crores. But in FY26, you can see the share of manufactured is increasing. What benefit does it give you? Does it give you any benefit? So on the top line, it remains same, because roughly the price is same. But here what you are trying to do is, once your utilization on the factory increases, then you can actually optimize on the margins later. And that is why it's a reclassification of the revenue. But then here you will try to always optimize on the margins, and hence you can see the margins could be increasing, as you can see on the also on the first slide. I'll share this deck. The margins do have room to grow here, right? So that's what one angle of playing this is, that the instruments manufactured and then the regions on top of it, right? So what do they have? Is the capacity constraint? No, because what they have done is, even before coming to the IPO, they funded their new unit 4 with their some accruals and then the debt also. What does this do? This gives them a very big capacity, which is the 75.5 million rapid ELISA kits, right? It can produce. It can also produce 93 million glucometer strips. It can also generate regions, 1.5 million cc regions. You can see the region capacity already is in the unit 1 also one as 1.27 million. And then there are glucometer devices also which it produces, right? Why do they require so much of the capacity? Because what the management is claiming is, from here they are set to achieve the target of 1000 crore whenever they can. Let's see when they can. But then this capacity gives them the flexibility to do it. And then what do they want to do? They want to club all the clinical chemistry kind of regions at one place, all the chemical all the instrument manufacturing at one place, and then all the kits manufacturing in the one space, because then it optimizes on the operations also, right? So that's what on the right side you can see how the IPO was funded. IPO was funded by IPO came at 214 crores, where 93 crores went into the capex, working capital, and 90 crores went into the debt. Now, what debt has been repaid? That is also something we need to see, whether it's a long-term debt or whether it's the short-term one, which was for the earlier working capital. Now, let's also look at what do they have in the CWIP. So in the CWIP, they already have an item sitting for 19.31 crores, and then the CFO says it's getting used as a warehouse as of now, and then they can actually expand this, which is again which is an adjacent plot to the unit 4 capacity, and if required, they can use this capacity in future. So what's my read on these products where the revenue generation is coming from? So wherever they are mentioning that clinical chemistry regions, right, and they're guiding that they will grow by 30 to 35%. Uh, so here the activation needs to be taken care of. Now, these regions, you're not going to sell as a region independently alone, right? There are buyers there, but then the assumption, baseline assumption here is that you will be topping it on the installed base of yours. Now, we will also see that how this will pan out. What is activation mean in the further slides. Then there are hematology regions also, right? Then yeah, so there are some of the contradictory things that the CEO says that we have grown over more than 50 to 55% on the hematology regions, but then when you actually calculate, it's around 19% itself. And then you actually need to see that out of 96,000 kits, and then you have 32,000 kits of headroom, but then there is a capacity cap that would be coming in the next few years. And then management has not quoted anywhere, neither do they have any regulatory approval on expanding the capacity anywhere for the hematology regions, right? Then the next driver comes as the Rapid or ELISA kits. Now, this is the new one which they have. This is again a very big one, and I think this is the fastest line which can grow, because this requires these are the ELISA kits. What does it mean? That you can sell these kits as a loan, right? So what management is also expecting is they'll get some government contracts, and they'll try to route it through their distributor. And one of the thing which I would like to highlight is they are part of a company which is called POCT Group, right? And this POCT Group acts as a distributor for them. And because this POCT Group actually takes contracts from the government and PHCs, healthcare centers, it acts as the O&M for them, and then that POCT distributes the materials of Qline Biotech into those PHCs. Now, everything depends on the POCTs getting all the contracts, and then POCT will be acting as a distributor. So, this is one part where we are seeing that, and also, but the company has said that they are also looking at the private distributors, but then. The whole bank to consume the 75.5 million kits, I think we'll have to see how does it grow into the market, right? This is something that to note. Then traded regions are the ones where you already had installed the base. So you had the installed base of the imported or the traded machines here, and then some customers do require that I want the imported region itself. So that's what the import looks like, right? And then as we spoke about the instruments on the manufactured instruments versus the traded instruments, what the management is guiding here is say 30 to 35% growth for the this year. That also means that they need to activate the base of the all the instruments that they have. So currently what they're saying is they have 1500 instruments currently installed, right? But then not all of them are active. Only 400 are active out of that. And then that means that they'll have to up their game on activation of this. That only then once, what does an activation mean? That you've gone through all the process, and then you have now you are now eligible to bring in regions, and then only that instrument can generate its own revenue. So I think that needs to be seen, because 43% of those uh, instruments still sit idle. And then traded instruments, similar thing. Even the traded instruments will have to go through the same part. So whenever looking at instruments, look at it in the combination that what is the instrument market growing at for Qline, that we'll see. And then how are they planning to have the manufactured versus traded? Where management has guided, they'll reduce the traded segment later. But then that will again, that we'll see how do we model that. And then consumables and AMC, ideally they should increase as and when you are increasing your installations on the kit or on the instruments. But we saw a dip on this, and then I think there is no answer that was fair enough that management could present. So this is something that we need to keep a tack on. Yeah. And exports and CDMO. We will talk about this as about the optionality in the next slide, that where does the optionality lie for the revenue generation from the above all the above revenue lines, right? So yeah, let's look at the next one. What does the activation mean, right? So as I mentioned, that 1550 is the installed machines, but the active are only 450. That means the ideal machines are totally around 1100. Now, if you activate all of this, right, the ideal machines, which the management is saying that they'll activate all of most of it, like a lot of it, and then they did not give a number. But then to meet their guidance, I think a lot needs to be seen that how do they activate these machines. So 1100 into say the roughly revenue per machine generates is 3 to 3.6 lakhs. So it can generate around 33 to 40 crores of a revenue. And yeah, so guided is around total 2000 placements are planned. What does this mean? Does this mean that it is all inclusive of all kind of instrument? Yes, it includes the Selectra, it includes the hematology analyzers, and it also includes the clinical analyzers. So it is not only Selectra. So the revenue per this will not be 3 to 3.6 always. It can be less also, right? So let's see. What's the optionality like? The optionality that Qline here today plays is uh, so a lot of tech transfers that it has taken from Europe, it brings it here. And then because there are a lot of moving parts, right? So these companies, what they're trying to do is they're trying to build it in India and then it ships it back to the Europe or anywhere. The current numbers have not been disclosed, but then that's what the CDMO export opportunity looks like. Now, for FY27, they've guided that they can do 10 crores of the CDMO export, but this is some a great optionality which, if works well, it can grow beyond. It can go beyond the normal revenues also. So yeah, so that is what we are looking at. And then, is this the only export opportunity? No. There are other export opportunities also, which is the other kind of items, the other clinical kits, which are not the ones which are having the traded ones, which are having the CE ones. Because here in the CDMO export, you would see the principle here, right? Because you already have the agreement with the technology transfer, you don't have to take approvals again and again for all those things. So the route here is very fast on the first one. In the second one, where is the ordinary export and where the management has guided for 5x of the revenue, here you will have to go whenever you are wanting to export a product, you will have to have a PQ, the pre-qualification with the WHO, and then you'll have to CE mark as well. You'll have to get it registered, get it vetted, and then you export. So while the friction can be initial in the beginning years, but once it is set, it can act in itself as a growth engine, right? So I think that's what management also is looking at when they say that they can grow to 1,000 crore revenue. While they have not given a very official thing, they've loosely claimed that. But I think these are the contributors when I try to model all of these, right? And that's where that's set. So what to watch, right? So now you know where are the revenue lines coming from. So what do you need to watch? So you really need to watch the activation number that's on the install base. So if they conduct any uh, con call, we can ask these questions. But then we also need to understand what does the installation base look like? Uh, what is their calendar look like for the planned new installations or new machines which are coming up, and then what is the activation target for every year, right? And coming to the working capital cycle, which is their Achilles heel, they have been having this issue of working capital, and because of the receivable days, because they generally, again, because they generally route their all the 75% of their revenue via the POCT, right? And that's the pain here, because these are government contracts and these are coming via the negotiations. So I think here they're facing problem to take these receivables now down, and I'm assuming that this will be same unless they reduce the distributor dependency and then move to a private player, right? So but then for the near term, it doesn't look like. And then we need to look at the unit force utilization as well, that whether what happens in the unit 4 is the management is saying that they'll have phase 1 and phase 2. What does the phase 1 mean? So in the unit 1 in Delhi, wherever they were building the clinical kits and the regions, what they want to do is they want to move the clinical kits from phase 1 to from Delhi to unit 4, so that everything on the clinical kit happens in this particular location itself. So we need to see that what happens there, and then in the phase 2 they will enter into the molecular segment also for the regions. And the next bottleneck that we need to track is the hematology capacity. Currently, it's 67% at 96,000 kits, but then we need to see what happens next. They have not mentioned anything about the fungibility. Nobody asked. I think we need to check that also. That are the manufacturing lines fungible? That means that can you manufacture other kits on the existing lines? So that is something also that needs to be seen. So currently the B2G, the business to government happens at 65 to 35. What the CFO is targeting is 50-50 by the end of FY28. Uh, let's see how does it pan out, but there is no harm in taking the management further. Right. One of the things which they have not talked about is they have not anywhere mentioned what is the royalty that goes out for the tech transfers that they have taken. Uh, Comes out from my estimate, it comes out 6.9% that on the revenue side for the all the traded instruments. For the or the manufactured instruments, but then we also need to see that when they do the CDMO export, will they also sell? Will they also pay the royalty to that, because then the margins will drop in. What management is guiding as 20 to 25% of the margins over there, even that will drop in. So that's something that we need to see. And this company is very big for its size for the SME. When it comes for IPO, I think we also need to track are there any plans for the main board migration, because when we see a lot of big investors like Carnelian and Abacus are sitting already here, that it already attracts a group of investors trust. We need to see that how does the further infusion of capital also happen, right? Because the kind of receivable days and the working capital it is at, uh, I don't mind seeing any equity dilution coming in future. And because you can only as much just to save your ratios, I think you cannot take a lot of debt on that side to keep up with your working capital. So that's what we'd like to track. And yeah, so that is what your calendar looks like. Let's track what does the full commercial production look like, and by the end of FY28, do they meet their targets, right? So coming to the favorite slide of everyone, so there's a financial model I've tried keeping here. What I've taken in consideration is I have been very optimistic in this. Even in my bear scenario, I have taken a very optimistic number of 20. They grow by 24% CAGR. It's again totally because of the installed base, and I'm basing everything on the basis that because the installed base will activate all of the regions, right? So that the organic growth will is bound to come. But even if it fails, we can model the other things as well. But then let's take 25% bear case, and then modeled it for FY28 and FY30. And exit P, we can say that this is a new kind of a IPO, right? So there is a partial peer, we can say, sits in the industry, but I would not like to compare it to that because the segments are totally different. While in the phase two, they might overlap, but then let's see what the market defines or decides to give this as a valuation multiple. So in that's the bear case. Base case, I've taken the 30% CAGR, which actually is in line with management's 3 to 4x kind of a guidance, right? So that gives you the 3x kind of a uh, revenue. And you can see here what's the revenue guidance that they have given and we have taken, right? And in the bull case, we have taken 40%. So all goes well, everything goes well in their favor. And what is the multiple that you'd like to give is 40x, let's say. So the valuation, I think in market, because it's again one of its kind, so it will fluctuate between 15 to 40. Depends upon where you enter, where you exit, and then yeah, it's totally upon your comfort. So what I'm seeing is in FY28, you can target it. It can actually do market cap with a 25% CAGR of 1563 uh, crores. In FY28, for the base case, it can go till 3000, and FY30, it can go for 5692 crores. Uh, in the very bull case, let's be very optimistic and see we make a good one. Then by FY28 it can be close to 6,000, and by FY30 it can be close to 13,000. While you if you want to see the model, then it is here. I have already linked it in the presentation. You can go to the assumptions, you can play it. It's a very plain model. I have not modeled the line by line items here for now, because there is a lot of questions that I have for management. That's why I have not modeled a lot of different sub line margins and the particular line items. But yeah, this fairly gives you a, a playground to play with the valuations and then see what does it come at. Yeah. So, and that's why my bull is not bull, it's extreme bull. So I think with that, uh, let's let me see if there's any slide there. Yeah, there's one that there are some risks. Yeah. So yeah, so there are some of the risks that we need to track. There are some of the related party transactions that has been happening. So these are the ones with the POCT group. They're working to reduce it. There's a Chinese competition that we need to track, right? Because all of these will be undercut by the Chinese prices. There's already a competitor in the market by the name of Avians, which is coming in, which is partnering with the Chinese counterparts too. So let's see how does that pan out, and then they will face this. So we need to see that all the pricing on the kits, right? Because they are going to supply to the governments, and government does not pay you premium for your kits always. So we need to track that. The royalty is something that we need to keep a track on, and then if they're moving to molecular and other kind of regions, their R&D spend seems pretty low of 1% of the revenue. If they really want to nail the high margin products where the region revenue is also high, the margin is high, I think the R&D spend should increase. That's what we need to ask. And with that, I think I'd love to conclude today's session for Qline. Thank you so much. Any questions, please go ahead and ask.
Yeah, wonderful, Yogesh. I think a lot of data points and the conviction. So one of the question is 3B Black Bio is their competitor. I think the answer is yes, right?
Yeah. Yeah, so currently how I would see is 3B Black Bio is their competitor now. Qline totally plays in the world of say clinical chemistry, hematology till now, right? It has just now come in for the ELISA kits and all of the kits. So 3B Black Bio works in the molecular side of the regions as well as these kits. So now there is an overlap, and there will be more overlap going forward.
Okay.
Yeah.
Yeah, guys, any more questions to Yogesh? One question I have for you, Yogesh, although I am also tracking, I have this position as well. But
Yeah.
see, they are trying to sell machines to the diagnostic labs and the hospitals and everything, but a lot of other players would also be selling it.
Yeah, right.
And eventually, they would not be able to sell it. They have to just place free of cost
Correct.
because of this competition.
Yeah.
So maybe this segment, I am a little bit doubtful whether it will generate money. So maybe only the blades will sell. Reserve will always be free in this case. Would that be the case you are looking?
Right. That so I forgot to mention that, but I mentioned that in the PPT. So what they're doing is even the CEO says, right? So all these machines we are only targeting 10 to 15% of the gross margin, because they will always keep these machines for free in the diagnostic centers, like the fridges in the Kirana stores, right? And if they are lucky, as the government pays, the government will pay for these machines. Otherwise, it's just this revenue that you're looking at, the pull.
Yeah, the good point is once they are in, it's kind of a real estate, right? Once the machine is placed, you cannot place another machine by another competitor. So because space are limited in each lab, so the real estate is taken over by this company at that point of time. So that could be a good model.
Right. Because they'll have to go through entire process of activation, and then all the processes, approvals need to be taken again, and then only new machine will be installed. So stickiness is very high in this.
Yeah, great. Any other, what is the life of the machine? I think
so 8 to 10 years is the
is it?
yeah 8 to 10 years is the life of the machine. If you would see, they already are quoting that they have 15 to 16,000 of machines already installed, but then they are towards their end of the life cycle, right? And hence, and that is coming from their earlier traded revenue. But now the number which I'm currently placing, and only from here that I'm placing, is the one which they are doing it right now. In the past 1 year, how much they have installed, and hereafter how it will grow. So I'm totally discounting the fact that they currently everything is going out of the business from their earlier traded machines.
Okay. Thank you, Yogesh. I think if any more questions, you can check in the chat
Sure.
and take it from there.
Yeah.
Wonderful presentation. So we'll move to the next participant, Jasprit.
Hi, am I audible?
Yes, you are.
Let me share my screen. Is it visible?
Yes, visible. Let's go
Yeah.
ahead.
Hi, everyone. So the company I'll be presenting today is called Susan Electricals India Limited. And the disclaimer, I'm not a SEBI registered analyst. And if you buy based on what I say, there's a good possibility you may lose money. So let's go understand the company. Before I start, I'll still like to give a brief 1 minute summary. So it's a very simple business. They sell conductors and cables. Currently, they are at a reasonable valuation. There will be a capacity which will be going live because of the money they have gotten from the IPO, and based on that uh, more capacity, again, there's a possibility that we may have around 60 to 70% sort of upside. Now, I'll explain the company. So what they do is they manufacture winding wires, conductors, and power cables. You can call it as a proxy of a proxy. If we consider that transmission and distribution is a big theme in India, while it is not running very well right now, but it is a big theme. And then we have the EPC companies, which will be, which are a proxy of that theme. Then Susan is a proxy of that because they are supplying these wires and cables and conductors to the EPC players and the government discoms. So their core products are these winding wires, aluminum conductors. These are a sort of conductors which you may have read in the, if you have read Transrail or Skipper kind of companies. And then they also have a couple of other, just a second. Yeah, medium aerial bundled cables and medium voltage covered conductors. These are not really very high tech, but when you have this rural electrification theme sort of playing out, that's where these are mostly used. Now, coming to their manufacturing facilities, they have three manufacturing facilities. One unit is for the winding wires and strips. The other unit is for the low tension cable, and then there's another unit for low tension and high tension cable. While there's the financials I'll discuss going forward. So once again, the products, these type of winding wires and strips are mostly used in your transformers, electrical motors. When we talk about the aluminum conductors, low tension cable, and the high tension cables, as well as the medium voltage covered conductors, they're mostly used in your overhead transmission and distribution lines or your power plant, substation, as well as railways. So a very basic sort of product which they have. It's very easy to understand what exactly they do, and you can probably also go to their website and understand uh, all these products. Now, the milestone. So the company started in 2007. Uh, they started with this winding wire and strips. Then they started selling to the government sector, power utility. What I like here is that from 2014, then suddenly in 2022, they diversified into the low tension cable, then high tension cable, and then this medium voltage covered conductor. While it seems like not too much, but if you look at it, this is also the time when the transmission and distribution theme started playing out. So to me, it seems like these guys know that, what are the trends and where do they have to go. So when we look at the management team, so Vishal Jain is the chairman and managing director. So what I see that not a lot of them have written fancy qualifications, but yeah, they have been running the company for a very long time. For example, he has been for the last, I think, 17 or so years, and this person, the whole time director, also has been with the company since 2015, and they are all expert in the wire and cable industry. Similarly, other people also in the company, they are all, apart from Ved Prakash, who is the CFO, most of them have been associated for quite a while. So these are the three facilities they have. All these facilities are in Ghaziabad, Uttar Pradesh. So they are not really huge facilities, as you can see from the photos, but uh, the kind of product they make, I think these facilities are good enough. So first one is the winding wire and strips, where they have a capacity of 3,300 tons, but the utilization is only 57%. The low tension cable, this is interesting, where the install capacity is 6,000 kilometer, and they have a very good utilization percent of 94%. And the third one is the low tension and high tension cable facility, which is currently sitting at 64% utilization. So going forward, I think there will be an expansion which will also come in this facility. Now, coming to the certifications, now if you're selling conductors and cables to government companies, you definitely need certifications. So they have a lot of these certifications and the type test approvals which are required. What I really like about the company here is that having the certification, it reduces your direct competition from 500 small players and places Susan in the top 20 wires and cable company. Uh, it's not a really big company. Right now, the market cap is around 450 or something. So it's a relatively very small company, and very recently it has entered into the this low tension and high tension uh, cable or conductor ground. So recently, the IPO came around 2 months ago. They raised somewhere around 70 crores or so, and most of it will be going to the funding of the working capital requirements. When we go to the financials, we'll figure out that while they show profit, which is going up, the cash flows are still negative. So that is where we will discuss this. And the second is the expansion in the unit 3 of their facility. So now, why is capacity important? Simply, we have all this transmission and distribution theme which is going out, as well as another important part is that their capacity existing is around 7,500 kilometer, which will increase to 12,000 kilometers. So they'll be buying a couple of machines, this 633 kilowatt triple layer continuous catenary vulcanization machine, as well as there's a stranding machine which they'll be buying. Based on that, the benefit which they'll get is that when you have these cables and you strand them to make a conductor, so that will increase the margin because they'll not have to outsource that thing, as well as the a lot of your government discounts, they want certain specifications which will come into picture only when they have these machines. At the same time, currently they have land which based on which their capacity can go from 12,000 to 22,000 kilometer per annum. So while right now we are looking only at this number, but going forward they have a possibility of increasing it even further. So when we look at their clients, all these clients are the mostly related, situated somewhere in Uttar Pradesh and nearby states. They also have Indian Railways and some EPC players, which they have not really mentioned properly in their RHP. So one of the areas that currently the operation states where they are operating are mostly it's the North India, and then they have this particular state, Telangana. Is it Telangana? Okay. But they are also planning to expand into the other states like Kerala, Tamil Nadu, Uttarakhand, Karnataka. So expansion is certainly there in their mind. So we have understood the industry tailwinds, that a lot of this is related to your 24-hour power supply push, which is where your transformers and all will come into picture, and then transmission and safer cables, which is where all these insulation also comes into picture for them. So when we look at the financials, their profit has grown from around 103 crores. Sorry, their revenue from operation has grown from 103 crores to 269 crores last financial year. So there's a significant jump over there, and that also comes from the fact that uh, they have recently in 2023 they ventured into the low tension as well as high tension cables. So that is one, as well as their EBITDA has also grown from 3 crores to 32 crores. So that is also based on the fact that these low tension and high tension conductors, they are relatively higher margin products. So another good thing over here is if you look at how their revenue is bifurcated, the government entities used to form around 90% of the revenue, but now it has come down to 35 or 36%, while the private entities have gone up to from 9% to 64%. There's still a catch when you look deeply into the RHP of the company. So they also are into trading apart from selling the product. So trading of aluminum rods and wires sort of stuff. So that is relatively low margin product, but that also may have contributed to increase in the private entities, because they have not really mentioned a lot about the which private entities they're selling to. Also, when you talk about the revenue from operation from repeat customers, so from new and existing customers, they have the revenue from operation is around 55%. So uh, it has decreased if you look deeply from around 80 or 90% to around 45% from the existing customer. But that also shows that your customer base is diversifying now, so which is a good thing. What we have to track uh, in this company is that whether it is coming more from the trading aspect or whether it is coming more from the product which you're trying to sell. So when I look at the shareholding pattern, so this was also one of the factors why I looked into this company when the IPO came. So in the anchor book, they had Motilal Oswal as well as Sage One, while they both hold around 1.5% of the company or 2.74. Being a small company, it's not a big sum for them, but definitely it shows that okay, some good players are also looking at this company, and there's a possibility of uh, good upside there. But we also have to remember that the IPO price was around 127 rupees, and currently it is close to 240 or 250. So they already are very close to a 2x over here, while we are not. The sales growth is definitely there from 103 crores to 135 to 269, as I explained. The margins were relatively low earlier, but I think after this, they had in FY25 9% and FY26 12%. So I don't think it's going to go above 12%, but we must keep an eye on it, whether it goes down. If it goes down, it might be because the trading activity might be going on. They've also mentioned their peers in the RHP. So the peers are Prime Cable Industries, Divine Power, and VMark. So if you look at, I think VMark has good margins of around 11.17% or 11.83%. So I think we should ensure, we should keep an eye on the margin. So I don't think about 12% will be possible. If it goes, very good. But this should be the baseline for us to track. Recently they came up with this press release for Q1 FY27, where their revenue shot up around 254% or 2.5x for Q1 FY27 from 26 crore last year. So that is a good thing. They also have a unexecuted order book of 142 crores. So if you add these two, you're somewhere around 240 crores. So last year's revenue number was 269 crores. So if we have, and they also have an active order pipeline of 150 crores. So considering this, if they convert some of it, we still have almost half a year left, and they get more orders, there's a good possibility they might go more than what they did last year. So the key risks for this company are, number one, revenue from the government customers. So they don't have too many products. It's just those aluminum and copper wire, low tension, high tension cable. Raw material, as soon as the prices start jumping around for aluminum and copper, so we can see where a lot of fluctuation in the margins as well. So they have negative operating cash flows for the last 3 years. So that is one of the reason why they will be using the proceeds from IPO so that they can fund their working capital. If you look closely into the statement of cash flow, you'll see that a lot of the money is tied up in the receivables and inventory. So receivables, definitely, if you are working with the government entities, you are going to have long payment cycles. And since they are also into trading, as well as they are entering into new products of high tension cable and low tension cable, so that is also one of the reason why the inventory is going up. So all three units are in Ghaziabad, they're very close to each other. So any problem we have in Ghaziabad, that's so anyway a problematic area. So if you have any more problems over there, so that's one big risk. Their employee attrition rate is very high, exceeding 50%. So that's one thing you have to keep an eye on, because I'm a strong believer of the work culture of a company. And like the presentation of Sekhar sir, where he mentioned that how the management takes care of employees. I don't know how good they are taking care of their employees, but that is one aspect which was really important for me when I looked at the key risks. So coming to the technicals, it listed at a from 127 was the IPO price. It listed at around, I think, 190, which was already an upside of 47%. What I see is that every time it goes up, then there's some selling, and then there's a big buying which comes in. Again, there's some selling, and I think yesterday the price went up around 12%. So more or less, this is it. Uh, Let me know if you have any questions. The way I see it is that the new facility, which will come live somewhere at the end of this financial year in Feb 2027, your capacity will go up by 60%. So you should expect more revenues coming in. And if something apart from that happens, we'll have to keep tracking the notifications of the company. Thank you. If there are any questions, let me know.
Yeah, the questions start from the last slide only. Why there is a rise of 13 or 12% last day?
Sorry?
Why there is a rise in the last trading session itself?
I don't know. Yeah, we should have done the session here, though.
Yeah.
Yeah, right.
Okay. Okay. Why VMark margin profile is much superior than Susan?
Right. I don't know about now. This year, their margin was 12%, Susan's. Theirs is 11.83. But I think it also might be. I haven't studied VMark in depth, so I can't really answer about that. But these guys have moved from a low margin product to a higher margin product. So that's why probably their margin has gone up to 12%. But I think these guys have been, VMark has been very consistent.
Yes, it is. And going forward, are they going for quarterly results? Any idea, or they will still stick
But
to 6 months?
that I don't know whether they will be going forward. I mean, they'll do it, but they seem to be very active. As soon as they listed in June, they came up with a PPT in June, which is a very good thing. At the same time, I think if you look at the PPT, so my PPT is almost same as their PPT, or but they've probably covered almost all the things you really want to see or understand about why I should be buying the company. So I really had to spend more time in trying to understand the risks rather than, because they have listed all the good stuff about their company, why, how they are going to be increasing the uh, going into the higher value product, and expansion will come up. So all of that they have already mentioned. So it seems like whoever is working, let me see. Yeah, this Moonwalk Capital, they have really made a good presentation for them.
Yeah.
But
Last question to you
yeah,
is, are there competitor with Vivid also? Just we covered this stock, right? Vivid electromech. Are they competitor? I don't think so, right? Because Vivid is more in panels and there's more in
yeah,
cables.
no, they are not. They don't seem to be.
Yeah.
Right.
Okay. Sure. Just have a
Okay.
look on the chat. There
Sure,
might be
I'll do
there
that.
are a few questions here and there. Thanks for this
Absolutely.
crisp presentation. I think just this Farshad is really waiting for you to finish faster. Okay, thanks. Just wait. So Farshad, here you are. You got 2 extra minutes.
Thank you. Thank you, Jaspreet, for giving me 2 extra minutes. I really need that. Okay, let me share. Okay, Puneet bhai, you can see the screen, right?
Yep.
Okay. So yeah, I think most of us would have. Okay, few of us, I'm sure, would be Led Zeppelin fans, and I would take my bet that most of us would probably have heard about their biggest hit, which was Stairway to Heaven. And just in case you haven't, which would be a big surprise for me, let me just take 15 to 20 seconds to remind which song I was referring to. Okay. So that's the song I was referring to. Now, there's a bit of the sort of context as to why I sort of picked this for my title slide. I was just thinking about, so the company that I'm going to talk about is going up the value chain. So that's basically the story of the company. And I was just thinking about, how to get creative about, presenting something that is going up something. So Stairway to Heaven somehow sort of, got stuck in my mind. I couldn't get out of it. So I thought, what, let me sort of take a little bit of shot at getting a bit creative. The rest of the content might not be as creative as this one, but I just thought that, let's start with something on a lighter note. So, Stairway to Heaven. All of us are investors on this call. And one thing among investors is that we definitely want to take elevators to heaven. Our heaven is basically making big money. So, elevators is something that is always in our mind when it comes to making money. So, I thought, why not actually sort of go and present on an elevator company? And no prizes for guessing. I'm sure most of you would have already guessed by now. I'm going to sort of talk about LT Elevator, which is going up the value chain. So now that I've wasted 2 precious minutes that Jaspreet has given me around the story, the context, the song, and making Puneet Bhai regret the decision to give me a slot, let me, go ahead and get started with the main content. So yeah, the contents, the agenda is pretty straightforward. A business deep dive where I'll be talking about few important triggers. I This is my fourth ALD presentation, and I spent a decent bit of time on the industry and the positioning because, especially for SMEs, where we look for, say, the TAM or the market ahead, this thing, the industry and the positioning within in the industry really differentiates winners versus laggards, if you ask me. Obviously, growth pipeline, the company specific triggers, what's the right to win, especially in the next 3, 4, 5 years, is something that all of us should be interested in. And that is something that will be covered in section 3. Financial performance and governance, just a brief look at the metrics. Obviously, all of that will be available on screener.in, so I won't be spending too much time. And finally, outlook and valuation. That's the final takeaway from the presentation that will be. Okay, so without any further ado, the business deep dive. So what do LT Elevator do, right? I mean, to put it very simple, they have two active divisions under them right now, which is elevators and escalators, mostly elevators, and something called Park Smart, which is smart car parking systems. The third one, Ricardo, which is direct to customer home lifts, is something that they have partnered with and they are in plans to acquire, rather merge with them. The official one hasn't happened until now, but for operational reasons, we can consider that the merger is done. But the big two businesses as of now currently are the elevators and smart parking. So if you talk about elevators, right? I mean, they don't manufacture everything. They are more of, say, for 30 to 40% manufacturing of the lift plus the fabrication, assembly, installation and maintenance. So what's the other 60 to 70% of the manufacturing that they don't own? That's basically the lift components like motors, controllers, a bit of software, etc., where they procure from the other suppliers, and then they add their, as I mentioned, the fabrication, the installation, the eventual end product, and then they ship it out, install, and they own the sort of downstream of the value chain. Smart parking, specifically related to car parks. Obviously, urbanization is a big theme that is going on in India. And obviously, all of us living in cities, especially whether it's tier one, tier two, and sometimes in tier three, car parking is becoming a big problem. And the concept of smart cities have come up, and one of the biggest components of smart cities is verticalization. How can we use the vertical space a lot? And that's where the smart car parks come in: stacks, horizontal, vertical, etc. as well. And LT Elevators is one of the leaders when it comes to both the technology and as well as experience when it comes to smart parks. And the Ricardo D2C home lifts is something I would cover a bit more in the upcoming slides. That's basically the big trigger as to why they are going up the value chain. But this is in a brief as to what LT Elevator does, right? So where does it sit in the value chain? As I mentioned earlier, upstream is the global component suppliers, the safety gates, the controllers, the motors, etc. In the middle, it's LT Elevators, which puts everything together. Downstream, there are three types of downstream end consumers, if you would. Currently, they are super active in B2B and B2G. D2C, which is direct to consumers, especially for home lifts, is where Ricardo comes in. That's their latest merger. And, again, we'll be talking a bit more about why going from B2B and B2G to a predominantly D2C player makes a big difference, and why it is a core critical part of our story at the end of the day. So currently, as I mentioned, the core elevators, automated parking are the two big verticals. The higher margin product is automated parking because there are very, very, very few players in this market in India, and LT Elevators is one of them. And it commands, a bigger margin. And we will discuss a bit of, margin going ahead as well. But, just a brief description of the core LOBs, if you will. What's the share and, what's the margins here? So as I mentioned earlier, the value is migrating downstream, and that's where LT is moving. So until now, they were more B2B and B2G. So whenever a elevator is supposed to be selected, it's typically the builder or the government or the municipality who comes in and selects it. And it's decided mostly on price and specification. Again, think about, B2G tenders. I mean, first, super political, highly based on personal preferences of the local officers, etc. as well. So it's sometimes it's not even a fair game, to be really honest. But these guys have still done very well, especially in B2G segment in the northeastern part of country, which is their strong point. And obviously through Ricardo acquisition, they are going to go pan India, and we'll talk a bit more about it. Gross margin 50%. But one of the biggest challenges that they are facing as of today, and no surprises considering that it's an SME, fast growing SME, it's the long receivables. Again, when you are in B2B and especially B2G game, long receivables is something that we always hear. And the brand itself, the developer put their brand on it and, run with it. So they don't even own the brand here. Now, D2C, the Ricardo channel. What is Ricardo? First of all, this is the right time to talk about it. So Ricardo Elevators is a company that was established 2 years back. That was pretty much about it. They didn't even had any sort of, actually they don't have any manufacturing presence. They completely outsource it. So it's a fully digital elevator brand dedicated to home lifts. So you have a home, you have a villa, you have a two-floor apartment, something like that, an old one where lifts didn't exist. So these guys come in without without doing a lot of digging, renovation, and things like that. They have their own special design, special technology, special engineering skill set through which they plan and put these small one, two, maximum three, four lifts inside it. And obviously, you can imagine this is a bit of play on one urbanization, but also on premiumization of the real estate world that we are living in. And again, here the customer is the end customer, the homeowner. So they are the ones who decides which elevator brand to go with. So they don't decide specifically on price. Obviously, I'm not saying that price is important or rather not important, but they decide more on the brand, the design, the service, etc. And since there are no middlemen here as well, the gross margin is sort of as much as 10 basis point or rather 100 basis point more here. And the cash cycle is positive working capital. So in the D2C world, 30 to 40% of the order value is sort of paid upfront by the customer as soon as the order is booked. And then once the manufacturing starts, another 15 to 20% gets paid. And as soon as the home lift gets installed at your villa or apartment, the rest of the payment. So you can imagine it's a positive working capital compared to their earlier world in B2B and B2G, working with the governments, working with the municipality or builders, where it was 150 days on an average, the receivable cycle. And the brand is LT Zone. I mean, until now it was Ricardo Zone, but since Ricardo is merged with LT Elevator, it will be called the LT brand. But so this is basically the concept of why the acquisition of Ricardo under the brand of LT is important. But I also wanted to go one step ahead and sort of share the management comments as well, so that it helps explain why this is so important. So I'm going to sort of quickly read out the important stuff. So what they said was, until now, in the last 4 to 5 years, we have substantially pursued B2G as a strategy since 2021. And why was it? Because they had the contacts, they had the certifications, qualifications from the government, and for a really small company, it was very important for them to get established in the market first. So they were literally taking whatever was given to them. And now they have established a brand, they have established a manufacturing presence, they have established the qualifications, certifications, etc. And now sort of, they are taking the next step, which is, the trigger of our story. Again, they are saying that we are pursuing this direct to customer, B2C market, etc. As I mentioned earlier, payments are pretty much in advance, much lesser working capital, and that gets us excited. And what they're saying is, in the current financial year, in FY27, roughly 35% of our overall business will comes from the B2C elevators, which is nothing but all the orders that Ricardo elevators, through which the merge has happened, will give LT elevator for manufacturing. And these orders does not come with any working capital requirement. I think that statement is a bit of a stretch. It comes with a little bit, but not as much as the B2B and B2G. And again, these are some of the things that I mentioned. Typically 30% advance when we secure the order, 20 to 25% when the drawing is approved, and the rest when it's installed, etc. as well. And for FY26, the B2C was almost negligible. They are targeting 35% of it. And one more important trigger point, which won't play out in the next 1 to 2 years, but maybe a little bit down the cycle, is that they've started exporting to countries as well, especially in Southeast Asia and Australia. And currently, the export contribution is only 5%. But the more important part is the pricing of it. 50% higher pricing compared to India. Manufacturing is happening at a very low cost base in India, but for the exports, it's 50% higher pricing. Currently, it's super negligible, but this is one of the optionalities. I've not put any optionality in my calculations at the end of this deck. I'll show you that. But this is one of the optionalities. If they become successful, in cracking the export markets and take this 5% to a 15, 20, 30% over the next 3, 4 years, 50% higher margins on export. So that's one of the optionalities that we need to keep in mind. But I wanted to make sure that, I sort of spend a little bit of time on this one as well, where LT from a pure manufacturing slash assembler, more B2B, more B2G, is going from FY27 start, has added the D2C channel in its portfolio, and that's going to make a big difference in its order book, in its brand, and especially in their working capital as well. So eventually, they will have elevators, they will have the automated parking, and they will have Ricardo. So that's basically the 3 engines and one platform that will work under LTEL. And that's what we need to keep in mind. But also from a business perspective, there are few things, there are few choke points that we need to be aware of, especially from an industry perspective, and see where LT is. So as I mentioned earlier, government pre-qualification, especially for the smart city parking, it's very important, and LTEL has that. A working direct to consumer funnel until FY26, they did not have that, but via the Ricardo merger, now they have a D2C platform as well. So currently, these two own it. Now, I'm going to also talk about in upcoming slides, they are going to take a big capex, but let me sort of talk about it a little upfront here. They are going to expand their capacity by 2.5x, and that capacity is going to come at the end of FY27. That's going to be a top of the line manufacturing facility with the latest certifications, with the latest ISO quality certificates, and with the latest German machinery, etc. as well. And one of the topics or one of the agenda points that came up in the union budget, the last union budget, was that for the elevator industry specifically, this IS 17900 code certification became mandatory, which means that it is going to push out a lot of unorganized players out of the big projects, out of, especially the organized projects, especially happening in the tier 1, tier 2, tier 3 industries as well. And LTEL will sort of get this certification automatically once the new factory comes in as well. So that is number one. Certified component supply. In the new factory, obviously, they are not going to sort of own everything that they were going to come in from the suppliers, but they are going to increase the percentage of components that they are going to manufacture in-house. So that is number two. And then the capacity at low capital cost. They are not the biggest elevator company in India. Johnson's, for that matter, is the domestic leader. And you have Otis, you have Kone, etc. as well. To win in this market, you need to sort of, one, have a decent bit of capacity. And if you can be one of the lowest cost producers, that's basically one of the advantages as well, which LTEL will have. And the final thing is install base and route density. This is a bit of a gap here for LTEL because currently it's quite northeast focused. But again, because of the Ricardo merger, and Ricardo has presence all over India, and that's where they will sort of get this install base expansion from northeast to rest of India, and all of these things would come in and full. But the main message is that LTEL by end of FY27 will cover quite a lot of industry choke points that are currently present in the industry. So that was a bit of, the business deep dive, what LTEL does, and, what's the latest, what are the 3 LOBs, and especially the D2C thing coming through Ricardo and why it's important as well. So let's spend a little bit of time very quickly, in the industry and competitive positioning as well. So Porter's 5 forces, always, one of the very simpler things to understand here. So new entrants, I mean, it's an improving situation for LTEL, as I mentioned earlier, because of this new certification requirements, the IS 17900. The cost of informal assembly is going to shoot up, and a lot of big projects, especially in tier 1, tier 2, tier 3 cities, players like LTEL only will be able to sort of take it up. Supplier power, unfortunately, currently is high because the components like the motors, the controllers, the lift software, etc. It's a concentrated set, and they have a bit of power there. But once a new factory comes in, a bit of manufacturing will go in-house there as well. But my guess is that it's still going to remain very high. Buyer power. Yes, buyer power is a bit high in the B2B and B2G space, where yes, the margins are still very good, but LTEL is not a price setter there. But in the D2C segment, that's where when they would work directly with the end customer, the homeowners, etc., that's where they'll be able to set the margins because the decision making is happening more around the brand, the aesthetics, the service, etc. as well. Threat of substitutes. It's low as of now because for vertical transport, you would still need the elevators, the escalators, the smart city systems, the home lifts. We still don't have sort of, a substitute product for them right now. And rivalry, again, decreasing because of the shift from unorganized to organized. That is one. And their two biggest competitors, especially the global ones, which also has presence in India, they have announced a big merger that's going to happen in 2027, and that's going to take up a bit of time for them for the merger to happen, for the synergies to happen, etc. as well. So they are not. So it's a bit of a window for players like LTEL to focus on operations and expanding their base as well. So that's a bit of on the POTUS 5 forces as well. Uh, I mentioned a bit around the market as well. So India currently is the second biggest elevator installation market in the world globally, and 30,000 crores is the estimated TAM. And what LT Elevator is saying is that currently we'll be able to address through this capacity expansion in the next 2, 3, 4 years 300 to 400 crores. So that's like 1% of it, to be really honest. So the runway for LT Elevator is quite big. So that basically is the main message that I wanted to give here as well. And this was a bit around the competition, and they are collaborating, etc. And both of these big giants are European elevator manufacturers, and their cost is already 30 to 50% more than Indian equivalents such as LT elevators. So even the required discount is large for them to come and play in the space that LT elevator is playing. Yeah, peer comparison. So for the industry space, I wanted to spend a little bit of time here as well. So the closest listed peer, I would say, is Aaron Industries. But the difference is that the business model is slightly different. So Aaron Industries is more around a bit of the component manufacturing, not the motors and controllers, but a bit around the structure, the doors, and a bit of fabrication. But they don't own the eventual assembly, manufacturing, installation. That piece basically LT Elevator does. But Iron Industries manufacture the outdoor part of the lift and give it to the elevator guys. So that is number one. And as you can see, there is a bit of gap in the valuation as well. And one of the reasons is that one, Iron Industries is a bit of an established player. I think it's around, if I remember right, between 3 to 4,000 crores market cap, something like that. And LT Elevator is still only like 500 to 600 crores. So the gap is quite big. Iron is established, and they have like the why I'm saying Iron is established as well is that their manufacturing facilities are quite stable, and the biggest indicator is that they've got a very consistent operating cash flow, which is very positive as well. And that's one of the indications that a company in a specific industry is established. They are comfortable with how execution is happening, and they have taken a lot of time with respect to their growth, etc. as well. But one of the points here is that Iron is trading at 40x, trailing PE, and LT Elevator is 28. The fact is that LT Elevator does much more than Iron. Not only the component manufacturing, but the installation, the fabrication, the assembly, and everything. And they are going D2C as well, which is higher up the value chain as well. So if LT Elevator fixes its game, does the capacity expansion well, and on time, and the D2C journey with Ricardo goes off smoothly, there is absolutely no way that I would see the gap between the valuations this much. Hopefully next year I would expect that the valuation gap would get very, very close, if not, over Aaron as well. I also wanted to bring a bit of global peer comparison as well, because one thing which I wanted to bring to your attention was that Otis and Kone. So these are the two biggest, giants in the world of elevator markets, right? And one thing is that their revenue growth is, low single digits. Most of the money that they make is through the AMC, annual maintenance contracts. And that's where LT Elevator will get 5 to 10 years down the line. Once their installed base grows up to a certain scale and size, and once the elevators, get a bit old as well, the AMC contracts, start contributing, quite a bit more. Currently, they sort of in the B2B and B2G, the developers and specific handyman companies, if you will, they are the ones who owns the maintenance of the contractors. But once LT Elevator starts owning the brand, especially in D2C and exports market, even the AMC would be owned by them. So that is something that once LT Elevator becomes from a 500 crores company to a 5,000 crores company, the AMC as a percentage of profits, as a percentage of revenue would grow that much. And that is sort of evident from the fact that how these mature global companies are deriving their money from as well. And I also wanted to bring up what's genuinely defensible, right, as well. So yes, safety components, D2C, precision fabrication. This is what would differentiate a company in this industry, and LT has it. The predictive and IoT maintenance. It's done by the global majors like the ones that I mentioned on the last slide. It's not yet built, but again, this is probably not something that is super important in the market that LT Elevator plays as well. And you would ask me like, why won't any other player come in the market and sort of, get it done? Why can't they do a lot of D2C advertising and get the business from Ricardo, which is a fair enough thing. But Ricardo now has the advantage of merging with LT, and LT has manufacturing. So Ricardo is basically advertising plus manufacturing plus installation plus potentially AMC as well. And what about the global majors? As I already mentioned, they are 30 to 50% costlier. So already the required discount is pretty large. So where would you want to be in the next decade? Because if you think about SME, right, you need to think about a little long term. So you need to own the customer, which is happening through the Ricardo merger, the D2C one that I spoke about. It owns a scarce niche, the Park Smart automated car parking. By the way, this was also an acquisition that was done last year, and it builds the annuity. Currently, again, the AMC is not very big, but once it becomes a 10x from here in terms of capacity, in terms of number of lifts installed, it will start owning a big chunk of that annuity as well. So that was a bit on the industry side of things as well, as to what's the right to win in a specific industry and where is LT, EL sitting as well. So from a growth pipeline perspective, so what you see here are, the different LOBs that they have, the passenger lifts, the multi-level parking, the AMC maintenance, and home lifts as well. So the highest margins today comes from the automated multi-level parking, which is the car parking I'm talking about. Very early growth. They actually acquired a company last year, and the growth is expected to happen in the upcoming years. They have got a couple of big projects in the northeastern part in Shillong and Imphal as well, which is in the tune of 30 to 50 crores. Half of the execution happened last year and the other half is expected to be this year. But as urbanization would increase, as the concept of smart cities would start kicking in, in the tier ones and tier two cities as well, LTEL will be expected to sort of gain quite a bit of the contracts here. The AMC one, yeah, it's, as I mentioned, it's like barely anything right now, but in the long run, it's structurally highest margin should come from there. And the home lifts is something that is starting from this year, and the gross margins on that will be the highest. And that's where even the working capital, as I mentioned earlier, should start taking care of it. The number of working capital days should start getting down. Small capex figure, but a large step up in ceiling. Okay, so I mentioned earlier 2.5x increase in capacity by end of the year. So they are putting up a new facility in Bengal. Actually, their company is based in Bengal, but most of their operations are in Northeast. And after the recent elections in West Bengal, the comment came from management that now we are going to expand in West Bengal as well, because earlier politically, we were not well connected and that was not suitable for us. So maybe in the home market as well now, they are going to grow. But they have announced a big capex actually last year. So the new Bengal facility is going to come up by Q4 of FY27. 25 crores is what they are going to invest. And the capacity that's going to come up, the revenue capacity is in the range of 300 to 400 crores. So that basically is a huge asset turns as well. And one of the reasons is that they are not sort of manufacturing quite complex components like the motors and the controllers that still they are going to import, but it's more around putting the entire thing together. They are still going to manufacture some of the lift components. They have the skill set, they have the knowledge, they have the know-how of doing this thing, and they are projecting that they are going to sort of get 300 to 400 crores out of it, which is very highly efficient operations. So that is one of the triggers. And obviously, this big facility will give them their proprietary controllers. That is something that they are going to insource a little bit, manufacturing capacity at a very low cost, and the field execution as well through Ricardo. So they eliminate a bit of middlemen margins. They will go into DTC, and eventually once the scale comes up as well, the AMCs as well. The Ricardo integration, again, I've mentioned this earlier as well, so I won't spend so much time, but I wanted to bring some management comments as well. So again, very efficient working capital business, long-lasting D2C brand, margin accretive for sure. But they have also mentioned that in FY27, Ricardo is going to expand their number of branch offices, not only in India, but also globally as well. So in FY27, there are going to be some initial investment in marketing and business development, and hence that increase in margin from D2C won't be visible immediately. It will take a little bit of time. So as I mentioned earlier, 58 to 60% kind of gross margin, but it will come from FY28 and not from FY27. Financial performance and governance, it has been steady growth. FY25 to FY26, you will see a huge growth. So the organic growth in the elevator business was 50%, 51%. As I mentioned, the smart parking car business was acquired end of FY25. So that was basically a big inorganic jump in revenues that you would see. And similarly in FY27, you will see a big jump as well because of both organic growth and as well as a bit of inorganic from the Ricardo Elevator merger as well. Working capital, again, I mentioned here earlier, I won't spend too much time. Operating cash flow is negative. Negative OCF, as I mentioned earlier, project-based hyper growth, SME, they were focusing on getting business. That's why they were focused more on the B2G, B2B. Now they consider themselves a bit more established, and now they want a bit increase of D2C contribution. And hence, from here on, from FY27 onwards, we should see, the working capital days gradually reduce as well. Very quickly on the leadership, Arvind Gupta is the promoter and MD. He established it in 2008, long time in the elevator business, etc. But the guy who is running the show is his son, Yash Gupta, product of IIM Ahmedabad, and he has been with the business throughout, etc. The last one on the list, you see Neeraj Hemnani. So he is the one who joined from Ricardo, and he's going to be the CEO of the home elevator division in the new entity as well. So yeah, but Yash Gupta is sort of super ambitious, super focused on this verticalization and the saving of spaces, etc. That's a concept that he's working on, and decent bit of not promoters, but non-promoter big entities are backing Yash. For example, the promoters of Polycab, and I'm forgetting one other big company, but at least the promoters of Polycab, are backing Yash and LT Elevators here. So yeah, good company to sort of look forward to as well. Capital allocation strategy, very quickly, whether it's a part Smart acquisition, whether it's the IPO, the Ricardo merger, new manufacturing facility, everything is focused towards either elevators, type of elevators, smart parking, etc. as well. So it's not as if they have gone into a hotel business or something like that. So super focused promoter group, management group into the business as well. And obviously they are reinvesting at a 30% ROCE. So the dividend policy is nil, and that should be the way for high growth SMEs as well. Finally, the outlook and valuation. Again, the guidance is grounded according to the management. So let me put it this way: the management has come up with a bit of aggressive guidance. I've taken that not as the base case, but at the bull case, which I'm going to show you. But what they're saying is that, yes, they have 2.5x capacity, which will come by Q4 FY27. It's a very important thing that it comes by Q4 FY27. Otherwise, all financial models go out of the window. Already, they have an executable order book of 330 crores plus 70 crores from Ricardo that is coming this year. So roughly give or say 400 crores of order book. So very, very good visibility as well. Ricardo is going to expand this year, both with respect to touch points locally and as well as globally as well. So a bit of spend is going in there. So the high Ricardo margins is not going to show up in FY27. And eventually by 2030, the home elevator market, which is a big market, according to them, that's going to grow super fast. They want to be, 15% share there as well. So what they're saying is that by mid of FY28 or end of FY29, their revenue is going to touch anywhere between 350 to 400 crores. So that's a number that please do remember once I'm going to show you the evaluations. Export-wise, orders coming from Malaysia, very, very few, 5 to 6 elevators per month, but they are establishing offices in Thailand, Indonesia, Philippines, Australia as well. And as I mentioned earlier, 50% more pricing compared to the Indian market. Again, because the new capacity is going to come from end of FY27, to make sure that the rest of FY27, the orders don't go waste because of lack of capacity. They have already purchased some additional machinery. They have identified some operational bottlenecks. They sort of rented a small shed next to the existing factory so that the FY27 business as usual goes through and the execution doesn't fall down. And because of the big projects that they have done in Shillong and Imphal for the smart car parking, the credentials now have become great. Now they are eligible to bid for bigger projects across India. So that was the government qualification certification that I was talking about. So what they're saying is that roughly 80% growth will come in FY27. Don't be super surprised. A bit of it is coming from Ricardo. So that's the point I wanted to highlight. But on a regular basis, 40 to 50% growth is what they are saying over the next 2 to 3 years. So let's do some quick scenario building, right? I played with three things: growth, the margins, because D2C is coming in, and the valuations. So what you will see is basically the things on the left hand side, the revenues, what's the revenue growth, EBITDA, what's the EBITDA growth, depreciation, finance cost, tax rates is something that I've assumed, but I'll share the Excel with you if Punit bhai is fine as well, so that you can play around. And what's the PE that I can give in case the execution is well? What is the P that I can give if the execution is okay? And what's the P I can give if execution absolutely goes out of the window, right? So the bull case, as I mentioned earlier, bull case is the base case according to management. So let me, quickly explain the three scenarios that you see here using Excel, because that will be a little bit better. So let me quickly share the Excel. Give me a minute. Excel. Yes. Puneet bhai, you can see the Excel, right?
Yes, we can see.
Okay, great. So the bull case. So they have 400 crores worth of order book right now. So the thing with Ricardo's order book is that it's a very quick execution order book. Within 5 to 6 months of receiving the order, the order gets executed. And as I mentioned earlier, once the order gets executed, by the time the home lift is installed, you get 100% of the payment. So I'm assuming that in a bull case, which is the base case for management, 100% of Ricardo's book gets executed and 40% of the 330 crores of LT gets executed. So that's where this 82% growth comes in FY27, which is pretty much similar to the 80% growth given by the management as well for the year. For FY 28 and 29, the management is saying 40 to 50% growth. I'm taking the sort of lower end and a bit of stabilization towards the end. But the number to observe is this one, FY 29 396. The management has said that between FY 28 to FY 29, we expect that we'll touch 400 crores of revenue, which is pretty much similar to sort of my assumptions as well. 400 crores roughly worth of revenue by FY 29. Now, the second lever that I played was with margins. The management was very clear. The margins will expand, but not in FY 27, because there are going to be a huge marketing spend, increase in number of employees, increase in number of offices, especially in the Ricardo line of business, which is D2C. So we are going to stay the same EBITDA margin for FY 27, but from FY 28, we are going to increase it. So as the D2C percentage increase, and that's a 10% more EBITDA margin business, conservatively, we can assume if the execution goes smoothly, then we can easily assume that at least a 1% increase in EBITDA margin is a reasonable assumption to take, and hence this EBITDA growth, etc. as well. Depreciation, finance cost, tax rates, as I mentioned earlier, I took my assumptions. I'll share the Excel file, play around with it. But let's get down to the main numbers, right? So what I'm saying is that currently the P is something around early 30s, 32 exactly. So if the execution goes well, let's assume if we give 35 PE for 27, 40 PE for 28, where they actually show that the capacity has come online in FY 27, Ricardo integration has gone very well, and the number of export orders, the number of Ricardo orders has increased pan India and pan globally as well. This will come very close to the peak that is given to Iron Industries, which is actually not as well integrated in the value chain as well. But the market, if you ask me, will reward if those triggers and those milestones are met. And then obviously, we are in a bit of a good run in the market now. Let's assume that typical small SME cycles work for at least 1 to 2 years, give or take. So if the execution goes well, 35, 40 PE, if the growth sustains, is good. And then eventually, the PE will also taper off as the market situation goes in as well. So the upside that you see from the current is something like this. These are eventually calculations, but 112 to start with, going up to 376% by FY 30. But the CAGR is what we should look at, because SME, if you are investing, you invest for at least 3-4 years to see the full cycle, and that's where is the bull case. Again, this is the base case according to management. Now, if I go to the base case, I'm assuming that the order book execution might go a little slow. 37% of the current LT book, 85% of the Ricardo book gets executed, and in this year, which is FY 27, and we hit the 400 crores not in FY 29 but closer to FY 30. And even from a margin perspective, as I've assumed that instead of staying the same in 27, the Ricardo expansion cost actually will hit, and margins will go down to 23%, and then go a very small increase by 24, 25, 26 as the merger would happen, etc. So in that case, I would say the market would not reward it as much as a 35 or 40 PE. Maybe it will stay at the current PE, which is early 30s, 30 PE, and then eventually taper off to 25, 20 as the market situation cools down. But even in that situation, a CAGR of 33% is something that we can sort of expect if the market rewards it in this way. And then finally, the bear case. I'm assuming that, listen, 35% of the order book and 70% of Ricardo's order book gets executed in 27, which means 50% growth against an 80% guided by management, and a 35, 30, and 25 against an expected 40 to 50% growth guided by management. And the margins as well, it will grow a little slower than expected. So even in that case, eventually over a period of 4 or 5 years, a 16% sort of a CAGR is what you should expect. And obviously, even if you observe, I have not given as high a PE compared to the base and bull scenarios. So again, to sort of quickly rewind, I've played around with the revenue growth, the EBITDA margin increase because of exports and D2C, and the situation depending on the market, what sort of P's it can give, etc. as well. I'll share this Excel, play around, and then we will sort of do it. So let me sort of quickly go back. I only have just a couple of slides. I'm sure Puneet bhai would be like angry at me for, exceeding the time, but I won't take much more time than this. Um, yeah. Technical view, again, it's in a blue sky zone, strong uptrend since April 2026, since the SME market started doing well. And honestly, one of the best performing SME stocks. The only thing I can say right now is that it has a strong support at 237. And I expect that, this support might be touched because execution might be a little up and down in FY27 because the capacity is only going to come by end of FY27. So depending on how the order executions happen, if there are some logistical challenges, etc., it can go a little up and down. But 237, is a good range to sort of, consider because it's a very good support. Okay. It's an SME at the end of the day. You always need to ask questions about SME. Never ever believe what the management says. That's it. So what I'm going to give you guys is the questions to ask the management or the things to track. If you guys don't get this in the next 1 year, forget about investing here. So D2C, are they on track to exit FY27 at 100 plus elevators per month for Ricardo, which is, or in other ways, they mentioned that in FY27, 35% of revenue will come from D2C. Yes or no? Are we on track for new facility commissioning by Q4 of FY27? Because that's a number that we need to track. What they also mentioned that they are also looking at another potential acquisition with more of a patent and technology mode sort of a company. They didn't give any sort of information on what patent, what technology, what company, but let's ask them. They also mentioned that raw material prices increases. In D2C, it's a direct pass through. Even in government and B2B, we pass through, but with a bit of lag. So always need to grill whether have you managed to pass through or not. Have we managed to show improvement in working capital days? If the company is claiming that I'm going to increase D2C with a better working capital, then they need to show by end of FY27 improvement in working capital. Otherwise, it's not a good sign. Have we managed to sustain the order book growth north of 40%? They should ideally, again, because Ricardo merger has happened, so more orders also need to come in there. And I wouldn't hold a big gun to their head for the AMC and maintenance book for the next 1-2 years, but at least if there is a small increase every year with a considerable number at the end of 5 years, that's the direction that they should definitely look at. But these are the important questions that I'm going to give to you to track. If they fail in probably 30 to 40% of it, just take it easy and wait for the good execution to come in. The key takeaways, absolutely last slide, I promise. Industry is established industry. It's a direct proxy to urbanization and real estate, and it's very importantly moving towards organized players. Product, it's a critical product. There are no substitutes for it as of now. The players, limited number of organized players, limited number of domestic players with the scale, technology, and triggers compared to LTEL. And our company, domestic leadership, not with respect to site, but with respect to regulation, cost, and integration advantage, it's a domestic leader. Triggers, very important. It's entering into a D2C channel, which is increasing margin. Its TAM is increasing. Big capex is coming. More number of smart city projects is coming for its highest margin LOB business. And from a returns perspective, I think reasonable valuations. It has potential to be a strong, consistent compounder if they answer the questions that I put on the last slide. So yeah, that's pretty much about it. So it's going up the elevator value chain to heaven. Hopefully it will take all of the investors to there. So yeah, that's about it from my side. Sorry, Vinith, if I took a little bit of extra time.
In the market, stairs takes us up and elevator brings us down, but you are trying us to make the elevator go up. So we'll see how it works. It's
Yes.
a good company trying to do the good acquisition and the work in between.
Yes.
And a few questions from the people. One is on the low cost Chinese products. Anything on that side if you are aware?
Low cost Chinese products, yes, there is obviously all of these things. So there are a few things, right? Number one, for the smart city LOB, which is roughly half of their business right now, it works on government certifications, government regulations, qualifications, etc. So it doesn't matter whether even a Chinese company would come in or not. For the new business D2C, again, as I mentioned, it's not a price sensitive business, it's a brand sensitive business. The only competition that might come in from low cost Chinese is the B2B/B2G, where the developers bring out the tenders and sort of, just asked all of the players, whether Indian, Chinese, to bid. And again, a big percentage is B2G, and they are mentioned repeatedly that they have the right connections, they have the right, I would say, uh, credibility with the B2G government authorities, especially in the northeastern region, and that's why they keep on winning the orders. Again, their win rate obviously is not 100%, so I'm guessing that some of it might go to low cost Chinese providers as well. But one thing we need to understand here is that although cost is important in B2B and B2G, but the safety, regulations, quality of the product as well is important, because eventually it impacts lives as well. So I would say yes, it's there. They have also mentioned it, but on the other hand, they have repeatedly highlighted that we have the credibility with the government authorities. That's why we have gone very big in the last 5 years. Now we want to move a little bit ahead. So that would be my answer, give or take, on that piece.
So are they also into high-speed elevators? I think the question is coming from, like, there are very high-speed elevators in Dubai and
No, no. They are into sort of the simpler side of elevators, escalators, and obviously through D2C in the 2, 1, 2, 3, 4 ones. But no, they are not into high-speed fancy elevators. Those will still go to the Otis, the Kones, the Johnson lifts, etc. as well. So this would be probably, I would say, the mid-tier market is what I would say is where they play.
Yeah. Okay. Excellent presentation as always, and
Puneet,
excellent articulation skills.
Puneet, I wanted to add a point on this.
Go ahead.
Yeah, Prashad bhai, excellent presentation. Simply loved it.
Thank you.
So one important structural tailwind that we have not talked about in this business is aging population. So I'm seeing lot of buildings with just 2 floors. So even they are going for these kind of escalators. And so one of my relatives, he has a duplex, and within his duplex he has installed an elevator because it was it was getting difficult for him to climb to the second floor. And in second case, my father-in-law lives in a township which has flats of 2 stories. So there are like 30 such structures, and they're installing within single society, small society. They're installing around 10 such elevators just to reach the second floor, because the flats on the second floor, the aging population is not able to reach them. Just wanted to share.
No, absolutely. Even my parents moved from a new house just last month because the old house did not have the elevators. So yes, you are absolutely right. Yeah, that's why this segment is not as price sensitive, the D2C. They are like, who can do the work without disturbing the house a lot, without digging a lot, without changing the house structure a lot. That's where Ricardo has this, special engineering skill set, where they claim at least that without disturbing a lot, we can come in and do this 1 floor, 2 floor, 3 floor sort of a stuff. So it's not a price sensitive segment, but more of a service sensitive segment, I would say. But yes, absolutely right.
Correct.
Okay. Great point, Saurabh. Okay, thanks, Prashad. Just have a look on the chat in case I missed any questions. Move to the next presenter, Mithun.
Hi, can you hear me?
Yes, I can hear you.
Okay. So let me start with. Okay. So where are we? Where are we? Okay. Let me know once you are able to see my screen.
Yes, we can see your screen now.
Okay. Great. So first of all, I'm thankful to Puneet bhai for arranging this session and having the wonderful presentation by all the presenters so far, and so much of learnings every time the ALD is presented. And here I am being part of ALD almost since beginning. So I wanted to talk about a company, but before talking about a company, I just wanted to give clarity on SMEs, on small caps basically. So first of all, there's a wonderful article given by the DSP Merrill Lynch. Sorry, it's not DSP Merrill Lynch, it's now DSP only. So small caps can unlock value, but not everyone has the key. That's the article name, and I will just give a gist. I won't go through the whole article. Small caps don't fall, they collapse. So in case of crisis, anything goes wrong. This is the large caps falling in 2008 crisis. This is the small caps falling in case of, this is an average, as in there would be a percentage would be far higher in our portfolio. In 2018, the ILFS crisis, 14% on the main board, 36% on the small caps. And that's the time where small caps was predominant, neither SMEs. In 2020 COVID crash, it is 38% on the large caps and 43% on the small caps. Over here, it is 8% in 2025 correction. Here we have a fall of 24%. So the underlying message is that in case market goes down for whatever reason, the internal crisis or external crisis, whatever the things are, the small caps do not have the liquidity, and either they have deep pockets, people having deep pockets to hold to small caps. So they likely gonna fall out. Why I'm trying to highlight this? Because people over here have a huge expectation in case of small caps and SMEs, but in reality, the returns are very good, but at the same time, the risks are very high because of the low liquidity. It almost falls every other year. So in case of Nifty 50, the fall is like 4 times number of such. For once in every 5 years, it falls. So once in every 2 years. So in case of Nifty small cap 250, the small caps have been as in 12 times they have fallen for every 2 years. The third, the reward for only when who have stayed basically. So you are in case of a small cap, you need to understand you yourself as an investor that do you have the patience and the time horizon to hold the small caps. So in case, but they makes money as in that's what the returns has been proving. So just before crisis of 2008, it is the 1 lakh invested turns out to be 4.3%, very small return. But as soon as you bought in case of the after the crisis effects, the same amount invested 1 lakh rupees becomes 17 lakhs. It's almost like 4 times of the before the crisis, as in just few months here and there. Similarly, in the case of COVID, 1 lakh invested is 2.9 lakhs. Here at the bottom, it becomes 5 lakhs. And this is all about the mutual funds investing in small caps, not in SMEs. In SMEs, it is really as in a struggle to come out when there is a something goes wrong. So before investing in small caps, see that your portfolio is big enough to having a small caps or SMEs where your portfolio concentration is not too steep. So let's say 10%, over 10 percentage having an SME is like is this key, and that's what my message is. Okay, so here I begin with the company. I wanted to highlight a company called Tipco Engineering. Tipco Engineering is a industrial machinery making company. Let me just uh, highlight, as in we will just watch a small video. This is only for 4 minutes, and we won't watch the whole video also. We'll just see.
What gives Maggie its iconic yellow? What makes Pepsi's blue unmistakable? What powers automobile engine wash for leading car brands? What coats a boarding pass? Or colors a Natraj pencil? Behind everyday brands and mission-critical applications lies precision process engineering. That is where Tipco operates. Tipco Engineering India Limited is an integrated engineering and manufacturing company specializing in industrial process machinery. From concept to commissioning, design, fabrication, assembly, automation, Tipco delivers complete process solutions with 3 core product platforms: Build Series, Disperser Series, and Homogenizer Series. The company enables controlled particle reduction, high shear mixing, and uniform dispersion across complex industrial formulations. This is engineered performance, built for consistency, scale, and repeatability. The company is led by Mr. Ritesh Sharma, promoter, chairman, and managing director, with nearly 2 decades of experience in machine manufacturing and turnkey execution. Ms. Sonia Sharma, promoter and whole-time director, oversees operations, administration, and organizational execution. They are supported by a seasoned leadership team across engineering, finance, promoter-led, execution-driven. Tipco operates through a fully integrated in-house manufacturing model. At its Sonipat, Haryana facility, every stage is executed under one roof. Engineering design, precision, CNC machining, fabrication and finishing, assembly and testing, quality inspection and dispatch. Installed capacity stands at 520 machines, with consistently high utilization levels. This integration delivers tighter quality control, faster customization, and operational scalability, without reliance on fragmented outsourcing. On Tipco machines are manufactured Maggie's signature yellow, Pepsi's blue, automobile engine wash for leading car brands, Natraj pencil colors, rocket fuel components for DRDO, car seat cover colors for Mercedes, Maruti, and Hyundai, thermal coatings for boarding passes of Indigo and GoAir, paint systems from JK and Sirca, even liquid components for solid-state ion batteries. From consumer brands to aerospace applications, Tipco technology enables precision across industries, paints and coatings, chemicals, pharmaceuticals, food and beverages, adhesives and sealants, specialty materials, construction compounds. This is engineering that's...
So this is what Tipco is doing, and so it's good to show where exactly their products are being used. Now here we have. Okay. So this is the basically the data about Tipco. The market cap is 357. Stock P is 14. Price is 172. Currently, it is I suppose the same price. I suppose I've taken this on Thursday. Friday would be 165, 168. Then this is the technical charts. This is the price action which has been happening for since its listing. So here the price is around 172. The volume is going for contraction. The volume side here there has been upswing. There's a guy called Lalit Dua who has been buying over here. So this is what Tipco company does, that's what they have explained in the video. The EBITDA margin is 26%, 17% as the PAT margin, which is very good as an EBITDA vis-a-vis the PAT margin. The ROEs are 25. The order book is 76 crores and they have executed around 180 projects under FY23 to FY26. Incorporation date is 2021. This is an incorporation. Before company getting incorporated, they were working under partnership firm basically. So basically the products are divided into mill series, disperser series, homogeneous series. Basically the mill series is basically breaking down the materials. It's like what we can talk about giving your food grains to the millers and they just grind it basically. So the mill series does that particular work. Disperser series is used for it's more like as in mixing up things, as in let's say the flour is mixed with water and they turns on to be high viscosity or low viscosity. High viscosity is a more as in it has more stickiness, and low viscosity is a low stickiness. And homogeneous genizer series basically is something which is used for blending of liquid. It's mostly used in the emulsification and paint industries. So their capacity utilization over here is in FY23 has been 82%, around 80% on an average. FY26 it was 89%. Installed capacity has been increasing from 363, they went to 560. They have executed projects for Ultratech, Silca, and MS Paints, JK Paints and MBT. MBT construction is nothing but it's a part of BSF chemicals. So these are the end use industries. That's what they have highlighted, as in pharmaceuticals, paints, food and beverages, sealants, adhesives, specialty chemicals, others, and ink and coating. So their products have been used for Maggi, Pepsi, paint industries, coloring of the chairs, paints again, and some other stuff, some other technical stuff, which we can discuss it further. This is how the balance sheet looks. The balance sheet has equity of 20.6 right now because they have raised the capital. Reserves are 79. The long-term borrowings has decreased drastically. I will highlight why the borrowings has decreased drastically. These are the short-term borrowings. And here we have the assets. The fixed assets also got reduced, as we can see, from 34 crores. It went to 17.72 crores. Inventories has been increasing trend. At the same time, receivables have been increasing trend. They have received the cash from the IPO. That's the reason we can see higher cash balance over here. The reduction in the fixed assets went from 34 to 17, basically because of the sale of the residential building by the company to the promoters. Further, the loan against the property was also transferred in the name of the promoters. Short-term borrowings has increased because of the higher sales and the higher working capital arising from the trade receivable. Cash balance is 60 because of the amount lying in the escrow account, and they have cash balance. This is their P&L. The P&L is, as we can see, it has been also in the increasing trend. From 35 crores, it went to 145 crores. The total income has increased from 35 to 146. EBITDA margin has been increasing from 10% to 26%. Depreciation overall is the same. One point to be highlighted, the depreciation number had a fixed asset, now it got removed also, and they will have higher depreciation coming years. I will explain the reason in further slides. This is the PAT from which has moved from 2 to 25.31. As a PAT, the margins has moved from 7 to 17%. So far it looks a decent company. There is nothing fancy as such. It is just a company which makes industrial machinery for the companies which required. But the point is the scale now, as in the scale which they are going to deliver and what things they have done now, and which was highlighted in their first conf call. So the first conf call they have highlighted their 5-pillar strategy. They are coming up with Pune mega expansion, capacity expansion required because they are already running at 89%. They have done a tie-up with German company. Then they are entering defense manufacturing, and then they are entering the export side also, as well as they are increasing the import substitution. With regards to the each 5 pillars, these are the pointers. The Pune mega capacity expansion currently it is 40% capex, which is 75% bank funded. It's already funded, and 25% capacity production at 25% capacity it will run in FY27, and it will reach 100% in next 2 years. So FY29 it will reach 100%. That is what their explanation is. This Pune facility will have the cosmetics, adhesives, personal care, all these kind of instruments, machinery gonna be made, which were not been made prior, as in the cosmetics and the personal care, which were not made. They guide for FY27 is 180 crores plus Pune partial contribution. If Pune's contribution, whatever it's going to be. So currently they have FY26 sales of 146. So FY27 would be 180 plus Pune's contribution of 25%. A jump over 24% over 146. Okay. A fully ramp up. So basically, the fully ramp up would be doubling the company's current installed capacity. Lexamix strategic collaboration. That is what the German technology calibration is. They have exclusive rights to Lexamix machinery in India, where they will manufacture for Lexamix in Europe, South America, and Middle East. The tie-ups open the direct exports, high-value process machinery, adding 3 new end markets: cosmetics, pharma, and food processing. So they are getting into these new sectors because of this new German technology, defense manufacturing. So defense manufacturing is the interesting part where more insights are required from the company. As in, we will wait for conf call second to get more clarity. But they have talked specifically about lab scale machine for rocket fuel dispersion, price around 36 lakhs per unit. What this rocket fuel dispersion is going to be used, how useful it would be, we can talk further. But these are long qualification cycles. Once won, they will, as in they will stick to this company. This is something where the company is trying to focus on. They have two specific projects which is going on in defense. One is the rocket fuel dispersion, and the second one is the coating side. Export expansion. Export share has doubled up to 7.1% of revenue in FY26. Last year it was 3.05. This Lexa mix will help in the export, more export driven business. Import substitution, they have highlighted their strategy over here, as in the pricing power, what they have. Tipco prices are, so just an example, if at all there are some European competitors which are offering at $10, they are offering at $6. Really same. At the same time, they have Indian peers, Indian companies, which offer at 4 rupees, as in $4. Let's say it is just a reference pricing. It's not like it's 4 rupees or $4. They have just highlighted that Indian peers will quote something at 4, then they will be able to sell at 6, and the same product is being sold by the European competitors at 10. So basically, they highlight the fact that they will get more into import substitution because European companies' product won't be bought in India because they are selling the same product, same machinery under $6. The order book momentum and S2 would be, the order book is currently 70 CR, and the revenue which has grown in FY26 half year, it has moved by 66%. Smaller orders are converting into 30 to 45 days. The larger one takes 3 to 6 months. Margin step up. The margin has already been expanding, as in that's what we have seen. I'm not sure whether it will expand further because 26% margin as EBITDA margin is very decent margin, along with the PAT of 17%. As in, if at all it goes further, we will be happy. Otherwise, we consider as same around 26%. Pune and Lexa mix volume at the higher complexity, the margins resets at sub 18% level for FY25, compounding profit on moderate revenue gains also. So basically, the operating leverage will play in. That's what they have highlighted. These are some parts, the snippets of conf call. The first conf call they had. I was not able to join, unfortunately, but these are some important discussion which they had in the conf call. So firstly, someone have highlighted in RHP that within the RHP, the promoters has a few different entities. They're functioning the same side of business. That's what they have highlighted. But here the promoter Ritesh Sharma has highlighted that they are similar but not the same sets of business. I've gone through the RHP also, and I've seen the documents over there. They have mentioned that they have these non-competing clause within all the another promoter entities for next 10 years. Basically, they won't get into Tipco Engineering's same side of business over there. We will come over there, as in there's another company called Tipco Engineering Works, which is more related to turnkey projects, but not exactly into machinery making products. That's what it can be seen in DHRP. The second point which they wanted to talk about the defense, basically. So here within defense, they have two process. The one is for the rocket fuel, where the rocket fuel needs to disperse in nano dispersions. That will enhance, I mean, you know the mileage or average for any missile. Earlier, it can travel up to 100 with a similar fuel. Now it can travel up to 140 and 150 after better dispersion with nitrocellulose. What do you mean by dispersion? Is breaking down of the materials in smaller parts. It's like, let's say dispersion you can understand on the basis of the experiment which we did in maybe in school or colleges. A single light passing through a glass will divide the light into 7 different colors. That is nothing but a dispersion. And the same technology, as in the same concept, not technology, the same concept is used over here, that the kind of machinery they are making over here, they will fit it, and that will release the materials when there is an outlet from the outlet at a nano in a much more granular part using some technology called nitrocellulose, and as a result they will get better mileage. That is what the interesting part is over here. I am not sure about any other company doing the same thing in within the SME space, or even though not in SME, even in large cap space also. They have highlighted the same fact in conf call that they are currently number only company which has this tie-up with DRDO, but I don't know in future if at all there would be more companies coming up, because the tech, if at all it happens, is successful, then it might enter. But again, it's a first mover advantage. If at all they can get into something like this and they can crack it with DRDO, then nothing like it. The second part, they are talking about the lithium ion batteries, which is they are specific about solid state batteries. They are doing some R&D, but they have not highlighted what exactly they are doing, but they are trying to expand this area. We'll get more clarity in I suppose in next conf call that exactly what they are trying to do, but they are doing some R&D for the last few years. And in case of defense, they are generating coating which is useful for defense products basically. So there is another company called Growell which does this specialized coating for the defense products, as in or the which leads to lesser wear and tear of a particular product, as in, so that kind of specialized coating, they are creating that machinery. Okay, so it's not a competitor to Growell. It's basically Growell would be a more of customer to Tipco if at all they are able to create these kind of products. Uh, Again, apart from that, they have highlighted about the expansion. So they are going with multiple expansions. Firstly, they are getting into Pune. Within Pune, why they are talking about Pune? Because Pune is a hub where they can have easy access to multiple different companies which are already present in Pune. As in, that's what being highlighted over here. So with even though after Pune also, they have also highlighted that they are also targeting more land in Sonipat, which is around 4 to 5 acres. They expand the current capacity factory, and so from next year, our Pune and Sonipat factory will be completely majorly started in new way. So my understanding is FY27, if 180 crores plus, let's say plus or minus another 25% from Pune facility, but Pune facility's turnover would be as good as the 180 crores itself. That's what they have highlighted. So let's say by FY29, the numbers would be like 180 plus 180, 360 only by getting Pune and the current facility on. Sonipat would be another capacity, and this is all going to happen exactly in FY28. That's what the point is. I don't have numbers. The numbers were not specifically provided, but we can make a rough guess on the basis of the details which are provided in conf call. So here they have highlighted the same fact, 146 crores, they will go for 180 plus the Pune location for the FY25, FY27, which will be 25% capacity. The Pune alone, this alone can touch 180%, 180 crores in this year. I don't know whether it's gonna do 180 crores in this year, but in one part they have mentioned that they can do 180 crore from a Pune facility. Apart from that, the another thing which they have highlighted is the number of products which they are doing for the paint companies. So it's like a more of another thought process which came in my mind is the proxy side which we used to play in paint industries. So initially I thought it's doing business only with Silica paints and smaller JK paints, but later on con call they have highlighted that they are doing with Berger. Berger is going next, as well as they are doing Nippon, Nerolac, everything. So every paint companies, even Asian Paints is also one of their clients. We are also doing with Asian Paints, but they are not going big in Asian Paints as of now, but they are going big with Berger and Ultratech. That's what this particular company is doing with multiple side of business. And this is a smaller company which is just listed not even a year back, as in it has been listed around the IPO price was around listed around 80 rupees. It moved to 180, 190, and then it started little bit falling, and it is around 170s right now. So far, this is this is what my thesis is around Tipco. I will be happy if at all you have any other questions. But another thing which I learned is I should also do some bull case, bear case, and base case. That would have been helpful. But currently the numbers are very scared, and they are very, so they are not given multiple. If at all I get multiple conf calls, it gives me an more answers towards what numbers we can get. On the basis of one conf call, I will find it really difficult to give you numbers. But this is very early bet which we are trying to do. Even though it has moved 100%, I think the runway is quite good. If at all they get the approvals for the projects which they are doing. Hello?
Yeah.
Okay.
Great. So your point is correct. It's difficult to get those numbers from one conf call actually, and it's okay not to. If you don't have the conviction, it's okay not to share. Also, that's fine. Each person is different. And so, any questions for Mithun, guys, on this? And there's the lovely newsletter kind of a thing which you showed from DSP, right? Gives you a good perspective of how risky the SMEs could be for us.
Yeah, the SMEs are quite risky. As in, we have recently C2C Advance as well as GSM foils. These are the known cases. As well as there are many other SME companies which I can't name it because they have been not been caught or not been proved anything wrong, but they have been known to the investors that people talk many good things about SMEs. Everybody is invested when things are good, but everybody has sold out or moved out early when things are bad. So I would people having SME exposure should have really big portfolio to take one SME bet also of 10% and more, something like that. And
Yeah.
that's the only thesis. Once you make money 4x, 5x in one SME, then you can take multiple bets out of it. But any person who is investing with 5, 6 lakhs of portfolio in SME, it's a very high risk, as in you never know. At one time, C2C was like 800 rupees. Now it is struggling around 260 rupees. GSM foils has been having two lower circuits, 20%, 20%. It's return of most of the amount. So, so that's the thing, as in that's the beauty of SME. It's a, it's a hidden
Yes.
hidden
So that's why
treasure. Either you can win or you can lose everything.
today's session specifically for SME, and hopefully nothing turns out to be like that. But there is what I would say is never say never for these
No, no,
kind of things.
I'm also invested in SME, as in most of the stocks which have been discussed over here, as in we all talked about it, as in, so I'm invested in few, sold few, something like that. I lost money also on CTC, so it's okay. That's the reality. But the point is, everything is good, everything is bad at the same time.
Correct.
Any questions? I will be happy to have you ask you. The another insight which I got as an let's say industrial machinery, which I forgot to mention,
Yeah.
but is about the Jyoti CNC. If at all, I read multiple conf calls, so I link it one way, another way. So Jyoti CNC has been operating at more than 100% capacity. That's what they have highlighted in last conf call. And they are expanding their capacity like anything, as in they are going from 6,000 to 16,000, and they are expecting that they will complete as in you will utilize their capacity by next 1 year, 1.5 years. The same thing is repeated by another company, Mac Power CNC machines. I think they are also going for multiple expansion. The results were excellent. So the industrial super cycle, the manufacturing super cycle, capex is going very big in India. That's what you can refer into the CNC machines. Even though companies in India, in fact, they are not buying CNC machines only from India. They are buying a CNC machine from Japan, Germany, every places wherever they think like. As in Thai Casting is one of the company who buys CNC machines only from Japan. Then there's another company, I forgot his name. They buy CNC machines only from Germany. But even though after doing that also, we have CNC machines and Jyoti CNC machines, they are working at 100% capacity, almost 100% capacity. Jyoti to CNC is 100%. Mac Power, I don't remember, but they are going for good expansion, big expansion in multiple places. So industrial capex is in super cycle stage. So that's what I can refer into. You can make money in CNC, you can make money in these kind of machineries, or you can make money in the tooling companies also, the fastener companies also, something like that. You have to just read and get your conviction created.
I think, yeah, you're correct. But it's a kind of a mega trend. It will not be like short-term momentum trend. So we have to play as a mega trend over a few years on this kind of companies.
Right.
So we have to be careful on what is the right valuation for those to enter for any stock, whether it is SME or non-SME. Entries in your hand.
Yes.
Once you enter as a group, right, or as an individual person, exit is very difficult. So averaging is also very difficult. So be very careful and make sure that your entry is correct. So that will only save you later. So that brings to the end of our presentations, and we discussed 10 stocks today, and all of them have wonderful tailwinds, capex, growth paths. 10 wonderful presenters give it, I think, lovely presentations. We have taken a risk as a presenter group to go into SME and discuss with all of you. I hope you all take care before you put your hard-earned money onto these stocks. Don't just jump tomorrow. It may kill your capital itself. So be very, very careful before jumping, guys. That's all I can say for this. And thanks to all the presenters. Without them, this is not possible. Thanks to all the audience. You have been continuously, almost 100 people continuously listen throughout the day. First time ALD reached that space where almost average is more than 100 throughout the day. So great work. So we'll soon come back with our ALD 10 in a month or two, possibly. Till that time, let's listen to the recordings I will share very soon, and I will share all the compiled PDF also very soon on these companies. So with that, I think we can close the session for today, and we'll engage in the WhatsApp group. I will open the ALD SME for discussions further to engage with the presenters soon. So there we can take up more questions and more follow-ups. So with that, I am closing the meeting. Thank you all.